Right now, millions of people are, well, they're probably sitting at home staring at their phones, right?
Oh, absolutely.
Watching that tiny animated delivery truck inch closer to their house on a digital map.
It is oddly hypnotic, you know?
It really is. And it feels incredibly simple. I mean, you click buy, and then, maybe 48 hours later, a box just magically appears on your porch.
Right. The magic of modern logistics.
That's exactly. But beneath that single click, beneath that little moving icon,
Yeah.
is a massively complex, chaotic, and honestly rapidly mutating global nervous system.
Mutating is definitely the right word for it right now.
Yeah. And today, for this deep dive, we actually have a document that pulls the curtain back on exactly how that nervous system is being rewired in real time.
And it's not a secret manifesto or anything?
No, it's an official SEC Form 10Q filed by FedEx Corporation. This one covers the quarter ending February 28th, 2026.
Which, normally a quarterly financial filing is just a rearview mirror, right? It's just looking at past performance.
Very dry stuff usually.
Super dry. But this specific 10Q, it operates much more like a blueprint for a company that is actively mutating to survive.
Right.
We are essentially looking at a snapshot of a logistics giant attempting this massive high-wire act.
Okay, let's unpack this a bit. What kind of high-wire act?
Well, on one side, they are making these aggressive multi-billion-dollar offensive investments, but then on the other side, they are executing this just ruthless defensive restructuring.
So they're building up and tearing down at the same time.
Literally.
Yeah.
They are breaking themselves apart and putting themselves back together at the exact same moment.
Okay, well, the mission for today is to decode this blueprint. Because understanding what is happening inside FedEx right now, it's basically a masterclass in where the entire global economy is heading.
It really is.
So to understand where they're going, we first have to look at what they are intentionally leaving behind.
Right, the big split.
Yeah, they aren't just, rearranging the executive suite or changing some titles. They're physically splitting the house in two.
It's massive.
Sometime late last year, in December 2024, the board of directors made this monumental decision to pursue a full tax-free separation of FedEx Freight.
Which is their less-than-truckload business. The heavy stuff.
Right, the heavy freight. And they are spinning it off into a completely new, independent, publicly traded company.
And this is really the defining theme of their current strategy. I mean, it is a massive unwinding of decades of corporate philosophy.
How so?
Well, for a very long time, the dominant logic in corporate America was synergy. You put everything under one massive roof to capture every single dollar from a customer.
Like a one-stop shop?
Exactly. If a customer needs to ship a tiny legal document overnight, you do that. But if they also need to ship 4 tons of industrial tractor parts on a wooden pallet, well, you do that too.
But operationally, those two things are entirely different animals, aren't they?
Completely.
It's like taking a giant do-it-all Swiss Army knife, right?
Mm-hmm.
And eventually deciding, you know what, it's actually just more efficient to carry a really good standalone screwdriver and a totally separate blade.
That's a great way to put it. Running heavy palletized freight and overnight paper envelopes in the exact same corporate structure, it's like trying to use a massive freight train to deliver a single hot pizza.
Sure, the pizza eventually gets there.
Right, it gets there, but the fuel, the track logistics, the specialized equipment, it makes the whole trip wildly unprofitable. They realize they need to separate the train from the delivery scooters.
And that physical incompatibility is what's driving this.
Exactly. Heavy freight requires massive docks, specialized forklifts, drivers with different commercial licenses.
Whereas express packages need what, like automated conveyor belts?
Yeah, high-speed belts, entirely different routing algorithms. So trying to run both through a shared corporate architecture just creates massive friction.
So by detaching freight, they're doing what? Trying to look better to Wall Street?
It's a classic unbundling strategy. They want to unlock distinct market valuations. Investors who want the steady, predictable returns of heavy industrial trucking can just buy the new standalone freight stock.
While the core company just focuses purely on the high-speed package stuff.
Exactly.
Okay, but the clock is ticking loudly on this corporate divorce. The split is targeted to be completed by June 1st, 2026.
Right around the corner.
Yeah. They're even changing their fiscal year-end from May to December just to clearly mark this new era.
A clean break.
But looking at the financials in the 10Q, this is a shockingly expensive breakup. In just this 3-month quarter alone, they spent $195 million purely on the preparation for this spinoff.
It adds up fast.
Wait, I have to push back here. They spent nearly $200 million in 3 months just on the logistics of separating. Is this level of corporate divorce normal? Like, how is that justifiable to shareholders?
It sounds absurd, I know. But you have to look at the sheer scale of the untangling required here. You are taking a global monolith and literally cleaving it in two.
So it's not just paperwork.
Oh, not at all. You are talking about completely duplicating deeply integrated IT systems. You have to physically separate shared hub facilities, divide up human resources.
And pay staggering legal and consulting fees, I imagine.
Oh, the fees are astronomical, plus massive accounting audits, setting up entirely new boards of directors. That $195 million isn't really a loss. It is the steep, steep cost of buying operational clarity.
They are also executing some pretty wild financial maneuvers to actually fund this. The filing notes that the subsidiary, FedEx Freight Holding, just issued a staggering $3.7 billion in senior unsecured debt on February 5th.
That's a huge number.
It is, but they aren't even spending it. It's just sitting there as restricted cash. It's basically locked in a vault, waiting to be distributed back to the parent company once the split officially happens.
Right, and what's fascinating here is that this is a very standard, albeit massive, mechanism in corporate spinoffs.
Really?
Yeah. The new freight entity is essentially taking on its own debt to pay a multi-billion-dollar parting dividend back to the FedEx parent company.
So it leaves the core FedEx business with a massive injection of cash to fund its own survival.
Precisely. While the new freight company starts its life with a balance sheet structured specifically for the heavy trucking industry.
Okay, so they are shedding the heavy lifting to move faster. That makes sense. But what exactly are they doing with the core package delivery business that's left over?
That brings us to Network 2.0.
Right. The 10Q reveals they are subjecting the core business to this ruthless algorithmic drive for efficiency, Network 2.0.
Which represents probably the most significant operational pivot in the history of the company. It's a multi-year effort to physically and algorithmically merge FedEx's previously separate express and ground networks.
Across the U.S. and Canada, right?
Exactly.
And they are moving fast. They've hit 390 locations so far. They finished merging the Canadian network completely late in 2025, and the U.S. rollout is targeted for the end of 2027.
But it's not a painless process.
No, it is visibly harsh. They announced a massive international transformation program at the start of the year that will eliminate approximately 5,000 operational jobs globally.
Which is huge.
And it's costing them $225 to $325 million just in severance and facility exit costs. There's also a separate European workforce reduction that just wrapped up, cutting another 1,400 employees to yield $150 million in annual savings starting in 2026.
Yeah, the human cost is very real.
Here's where it gets really interesting to me, though. We hear the word optimization in corporate press releases all the time.
Oh, constantly.
Right. But looking at thousands of global job cuts and hundreds of millions in severance, is Network 2.0 actually a technological leap forward in how packages move? Or is it just a fancy, futuristic name for old-school, desperate belt-tightening?
If we connect this to the bigger picture, it's really both. Because the technological leap is exactly what enables the cost cutting.
Okay, explain that.
You have to look at how FedEx originally built its empire to understand why this hurts so much now. For decades, they intentionally built distinct, overlapping physical networks.
Meaning express and ground were totally separate.
Completely. You would literally have a FedEx ground truck driving down a suburban street to deliver, say, a pair of shoes. And then 10 minutes later, a FedEx Express truck would drive down that exact same street to deliver an urgent legal document.
Because they had totally different timelines.
Right. They built this system for maximum coverage and distinct service speeds. It was a philosophy of coverage at all costs.
But running two trucks down the same street, burning diesel, paying two drivers, that is incredibly expensive.
It's massively inefficient, but in the past, they just didn't have the computing power to seamlessly mix those different service levels on the fly.
And now they do.
Now they do. Network 2.0 is a fundamental philosophy shift from coverage at all costs to margin optimization.
So they're using software to fix the physical redundancy.
Exactly. They are deploying advanced predictive modeling. The algorithms look at the entire flow of packages and make real-time decisions. Instead of rushing a half-empty express truck to a neighborhood just to hit an internal timeline, the system might calculate something different.
Like holding a package back.
Right. It might calculate that it's more profitable to hold that express package at the sorting facility for an extra 4 hours, just so it can hitch a ride on a ground truck that is already full and heading to that exact same zip code.
So they are using predictive data to ensure only one truck goes down that street, carrying both the shoes and the legal documents.
Yes. They prioritize the density of the delivery route over arbitrary speed metrics, provided they still meet the customer's promised delivery window, of course.
Right, the customer still gets it on time.
Exactly. The technology allows them to do more with less physical infrastructure, but the painful reality of needing less physical infrastructure is that you need fewer human beings to operate it.
So those 5,000 job cuts are the direct human result of eliminating that overlapping redundancy.
Unfortunately, yes.
But all of this extreme internal rewiring, the spin-offs, the Network 2.0 job cuts, the facility closures, it isn't happening in a vacuum.
Not at all.
Reading through the contingencies and risk factors in this filing, it becomes incredibly clear that FedEx is basically building a bunker.
Because the outside world is throwing unprecedented, uncontrollable curveballs at their operations.
Yes, they are forcefully optimizing the things they can control inside the company, precisely because the things they cannot control outside the company have become highly volatile.
It's a very defensive posture in a way.
Just look at the legal and regulatory hurdles that hit them in a span of just a few weeks this past February. First, a massive shockwave from the Supreme Court on February 20th.
The IEPA ruling.
Exactly. The court completely invalidated tariffs that had been imposed under the International Emergency Economic Powers Act, or IEEPA.
Right, which gave the government sweeping powers to regulate commerce and slap heavy tariffs on imports.
So the moment the Supreme Court struck those down, 3 days later, FedEx literally turned around and sued U.S. Customs and Border Protection.
They want their money back.
They are demanding a full refund of all the IEPA tariffs they've paid. But, and here's the crazy part, at the exact same time, FedEx is fighting off 5 separate class action lawsuits from their own customers.
Customers who want FedEx to refund them for those exact same tariffs.
Yes. It's like trying to remodel your kitchen while the house is actively on fire.
That's a great analogy, and this raises an important question for us. Regardless of the political mechanics behind the tariffs themselves, which we are entirely neutral on here, the business reality outlined in the 10Q is pure, unadulterated uncertainty.
Right, how do you even plan for that?
You can't. How does a publicly traded company accurately forecast its revenue for the year when it literally does not know if the federal government is going to write them a massive refund check or if a federal judge is going to rule that FedEx is liable to pay out millions to settle class action suits?
The filing explicitly states they cannot reasonably estimate the financial impact right now, but that it could be material.
It is a perfect illustration of how vulnerable global logistics networks are to sudden judicial shocks.
And it isn't just the courts. It is fundamental global trade policy. The filing notes the removal of the de minimis exemption for non-China imports back in August 2025.
Which was a huge shift.
For decades, de minimis was essentially a loophole. It allowed extremely cheap, low-value packages like a $5 phone case shipped directly to a consumer to completely bypass customs taxes and inspections.
It fueled a massive pipeline of global e-commerce.
But with that exemption suddenly gone, that entire global flow has hit a bureaucratic brick wall. Packages that used to sail through are now being taxed and inspected, heavily disrupting the traditional trade flows that FedEx relies on.
Because it changes the entire mathematical equation for cross-border shipping. When regulatory friction increases, the cost of moving goods increases.
And that depresses consumer demand.
Exactly. FedEx built its international infrastructure assuming a relatively frictionless flow of cheap e-commerce. When governments put up toll booths, volume drops.
And as if lawsuits and trade bottlenecks weren't enough friction, there was the physical reality of keeping planes in the sky. In November 2025, the FAA issued an emergency airworthiness directive.
The MD-11 grounding.
Yes, they grounded all Boeing MD-11 aircraft for mandatory safety inspections. FedEx operates a massive fleet of those specific cargo planes.
So suddenly you have a huge chunk of your global air capacity legally grounded on the tarmac.
Massive operational headaches.
It is compounding friction, right?
Right.
Regulatory friction at the borders, judicial friction in the courts, and physical friction on the runways.
Add to that the broader macro environment, declining U.S. imports, elevated global inflation, and high interest rates putting immense pressure on consumer demand, specifically international export packages.
It's a perfect storm.
So you have massive expensive spin-off costs, thousands of global job cuts, grounded planes, unpredictable lawsuits, and disrupted trade routes.
Right.
Given all of that, you would expect to look at the financial scorecard in this 10Q and see a bloodbath. You would expect them to be bleeding cash.
But the actual numbers reveal a massive, surprising plot twist.
They are not only highly profitable right now, they are generating enough cash to make aggressive, multi-billion-dollar acquisitions.
The financial results are incredibly striking when you juxtapose them against that operational chaos. What the raw numbers reveal is incredible resilience in their pricing power.
Let's look at Q3. Revenue actually jumped 8%, hitting $24 billion.
Wow.
Operating income grew 4% to over $1.3 billion. Net income jumped 16% to over $1 billion for the quarter. EPS was $4.41.
And they aren't necessarily moving vastly more boxes to get those numbers.
No. The 10Q explicitly credits higher base yields. That means they successfully charge more per package for U.S. domestic and international priority shipments.
And people paid it.
Domestic demand actually increased. They found a pricing sweet spot where demand didn't collapse even when they hiked the rates, completely outpacing their higher labor costs.
That is the ultimate test of a company's market dominance. If you can raise your prices during a period of macroeconomic stress and your customers just grit their teeth and pay it, your business model is incredibly durable.
But then we get to the offensive play. The 10Q details a massive acquisition. On February 9, 2026, FedEx joined a consortium to buy InPost SA in an all-cash public offer.
This is a huge move.
FedEx will hold a 37% stake, valued at roughly $2.6 billion, funded entirely by cash and new liquidity. And they are doing this while still declaring a $1.45 per share dividend and repurchasing $776 million in stock over the last 9 months.
It is a profound flex of capital allocation. They are signaling to the market that despite the chaos, they have the firepower to go on the offensive.
But hold on, I have to challenge this logic for a second. We just talked about Network 2.0.
Right.
They're firing 5,000 operational employees globally, disrupting thousands of lives to save maybe $300 million in efficiency gains. But in the exact same quarter, they turn around and blow $2.6 billion on InPost.
Which is a European parcel company.
Right. If I'm an investor, or frankly one of those workers, I am furious. Why are we firing the actual human beings, moving the boxes just to turn around and buy a bunch of metal boxes overseas? How does dropping $2.6 billion on InPost fit into the efficiency narrative? Isn't that a glaring contradiction?
I see why you'd say that. It looks like a massive contradiction. Until you understand the underlying mechanism of what InPost actually does and how it solves the most expensive problem in the entire logistics industry.
Okay, tell me.
InPost doesn't just deliver packages. They are famous for building vast networks of automated parcel lockers.
But you see them outside grocery stores.
Exactly. Investing $2.6 billion into that infrastructure doesn't contradict Network 2.0. It is actually the ultimate expression of it.
Because of the last mile problem.
Yes. In logistics, the absolute most expensive, least efficient part of shipping anything is the last mile delivery.
Driving to individual houses.
Driving a heavy, gas-guzzling truck into a residential neighborhood, stopping at a single house, and having a driver walk up a driveway to drop off a single $15 t-shirt. It is wildly unprofitable. The labor and fuel costs eat the entire margin of that delivery.
Makes sense.
But imagine driving that exact same truck to a single bank of automated InPost lockers situated outside a grocery store or a train station. The driver securely drops off 50 different packages for 50 different people in 5 minutes and then just drives away.
Ah, the delivery density completely flips.
Precisely. You drastically slash the labor, the fuel, and the vehicle wear and tear. The customer comes and gets the package on their own time. So buying a massive stake in InPost is an aggressive, offensive move to permanently lower structural costs.
So they are spending $2.6 billion now to guarantee unshakable efficiency later.
Yes. They are securing a dominant foothold in e-commerce infrastructure before their competitors can.
It is basically buying the cheat code to the last mile delivery problem.
It really is.
Wow. So to synthesize all these moving parts, I think the next time you look out your window and see a FedEx truck pull up to your curb, you need to remember that you aren't just looking at a delivery vehicle.
Not anymore.
You are looking at a tiny fragment of a $24 billion a quarter machine. A machine that is actively splitting its entire corporate structure into, fighting the federal government in court over tariffs, navigating grounded airplanes, and completely rewiring its global delivery network with predictive algorithms and billions of dollars in automated parcel lockers.
The overarching takeaway for you, the listener, from this document is that in today's hyper-connected, volatile global economy, even the most established, ubiquitous corporate giants cannot afford to stand still.
You adapt or you die.
Exactly. You either adapt and optimize your margins, or you become obsolete. Understanding these macro-level supply chain pivots, knowing the actual mechanics of why the truck route changed, or why a parcel locker suddenly appeared on your corner, it helps you understand the underlying currents of the broader economy.
Because it affects all of us.
Absolutely. It dictates the prices we pay, the availability of the goods we rely on, and the fundamental nature of employment globally.
It really puts that little tracking icon on your phone into perspective. And it leaves us with one final, deeply provocative question to consider.
What's that?
FedEx is the absolute pioneer of the integrated global network. They are the world's largest express transportation company. If a giant of that scale has looked at their internal data and realized that the traditional do-it-all, own-everything mega corporation model is simply no longer viable for the future, if they are being forced to literally break themselves apart just to survive and thrive, what does that mean for the rest of the corporate monoliths dominating our economy today?
That is the big question.
Will the next decade of business be defined not by massive mergers and acquisitions, but as the era of the great splitting?
It's very possible.
Something to mull over the next time you click Track Package.
Keep questioning the complex systems running the world around you. We'll see you next time for our next deep dive.